Welcome back to the Deep Dive. This week, we are trying to make sense of a really chaotic start to January 2026.
It has been a wild week in the global markets.
Absolutely. Our sources, we're looking at data on bonds, commodities, defense, tech. They're all showing this almost hypersensitive reaction to political pressure.
That's exactly it, especially around that January 9th mark. Our job here is really to cut through that noise, find the signal for you. The big theme is just the speed at which policy is hitting the market.
So that's our mission today. We're going to extract the crucial takeaways. We'll start with how these big policy moves are, hitting your personal finances practically overnight.
And then we'll get into the geopolitical shocks. We have to talk about oil and the whole situation with rare earths.
Right. And finally, we'll distill what the pros the traders are saying and what warnings they're giving. Okay, let's dive in.
Let's do it.
So let's start closest to home. House in debt, that kind of thing. The stage was already a little shaky, right?
The 10-year Treasury yield, which, is the benchmark for so many borrowing costs.
For everything, yeah.
It was already sort of inching down. December's employment data was mixed, so you saw that normal market drift.
But then something not so normal happened.
Not at all. Then we get this massive intentional shock to the system. The former president announces he's instructing his representatives to go out and buy, get this, $200 billion in mortgage bonds.
$200 billion. I mean, that is just, it's an unprecedented use of political capital to target one specific market.
It's not a suggestion, it's a directive. It's direct financial intervention.
So break down the mechanism for us. How does buying all these bonds instantly save a potential homebuyer money?
It's really just classic supply and demand, but for credit. So when a figure like that orders such a huge purchase of mortgage bonds...
Which are just bundles of home loans, essentially.
Exactly. You're artificially cranking up the demand for those bonds, and when bond prices go up, the yields, which are the effective interest rates, have to come down.
And mortgage rates follow those yields.
They track them directly, so the immediate effect was, it was measurable within hours. Mortgage rates just plummeted. We're talking the lowest level in nearly 3 years.
Wow. That really blurs the line between stimulus and, frankly, market manipulation. It shows you volatility isn't just about bad news anymore.
No, it's about unexpected intervention. And this wasn't an isolated thing either.
Right. There's a credit card proposal, too.
Yeah, to show you how broad the focus on the consumer wallet is, there was also a major push for a 1-year cap on credit card interest rates.
At what level?
10%. Now, that's not an immediate market mover like the bond buying, but it sends a huge signal. It tells the consumer lending sector that there's significant policy risk on the horizon.
And that focus on the consumer's wallet, it links directly to the global shocks we're seeing, because those shocks eventually find their way into prices.
They always do.
So let's pivot from domestic policy to the global stage. This is where things got really volatile.
Staggering is the word. Just looking at oil markets. Prices jumped over 3% in just 1 week.
And the sources are saying this was kind of a perfect storm, right? It wasn't just one thing.
Far from it. You had a couple of major geopolitical risk factors all hitting at once. The primary focus was Venezuela.
Maduro arrest.
The Maduro arrest and the massive uncertainty that creates. For an informed audience, this isn't just another headline. It's a huge question mark over a major OPEC producer. Who's in charge of the oil? Is supply going to be disrupted?
And that uncertainty alone is enough to send shockwaves.
Yes. And then you compound that with the ongoing sort of structural supply worries you already had in Russia, Iraq, Iran.
From sanctions, from regional conflicts.
Right. It was a week where all those risk factors just seemed to align perfectly or imperfectly, depending on your perspective.
And it wasn't just oil, was it? There was this other resource battle brewing, what the sources are calling the Greenland Gambit.
Yes. A resource war, like you said, but fought with words, not tanks, at least for now.
So what was the statement?
The former president came out and said the U.S. is going to do something on Greenland, whether they like it or not.
Which is not about buying real estate this time.
No, this is 100% about rare earth elements. Things like neodymium, dysprosium. These are the materials that are absolutely critical for everything. Defense systems, EVs, and especially high-end microchips.
It's so easy to just dismiss that as, political bluster. But the sources show it had an immediate effect.
Yeah.
It put China on edge.
Instantly.
So what's the actual leverage the U.S. is trying to get here? How real is this?
The leverage is control over the high-tech supply chain, plain and simple. Right now, China just dominates the processing and supply of these elements. So this move, this statement, it signals a new, aggressive willingness to secure alternative supply lines.
But it's a gambit, as they called it.
It is, and our sources did quote experts who were warning that this absurd bet is facing a big reality check.
Because it's not easy to just go mine in Greenland.
Not at all. It's incredibly complex, logistically, environmentally. The promise is still a long, long way from the reality. For today, the effect is mainly psychological. It establishes rare earths as a key geopolitical weapon.
And that's a perfect bridge, because the idea of scarcity in rare earths links right into the actual scarcity we're seeing in the tech sector itself.
Exactly.
So let's move into the specific sectors and see how all these pressures are creating these weird mixed signals for defense and tech.
The defense sector was fascinating. You had this really interesting split. On one hand, the former president's comments were seen as rattling domestic defense firms.
But not in Europe.
Not at all. European defense stocks actually closed higher. It seems like the market is betting that regional instability in Europe is a more powerful, more immediate driver of demand than, say, long-term U.S. defense policy.
And there was one clear winner in Europe.
Oh.
A huge one.
An incredible standout, Rolls-Royce. The stock hit a record high every single trading day of 2026 so far. It just underlines this belief that while U.S. firms are dealing with political noise, European firms are seeing concrete demand because of that rising geopolitical risk.
Meanwhile, back in the U.S., the commentary was more cautious.
Yeah, one domestic defense stock was actually cited as being among the most overbought this week, right after those comments, which suggests some traders thought the market was overreacting.
Okay, so let's shift to tech and AI. Here, the driver wasn't rhetoric. It was pure physical scarcity.
The sources couldn't have been clearer on this. AI memory is sold out.
Completely sold out.
Gone. And that is causing what they're calling an unprecedented surge in prices. This isn't a small thing. This is a supply shock that fundamentally reshapes CapEx planning for every single major tech company on the planet.
If you can't get the chips, you can't build the AI models.
You can't build the future. And while that's happening, you did see a bit of a political tailwind for some semiconductor stocks.
Right, the praise for Intel.
The former president praised Intel and its CEO, and that can give a stock an immediate lift. But you have to weigh that short-term optimism against a much bigger long-term counter perspective. Which comes from Algebris Investments. They provided this really vital context, calling China a country of engineers. Their argument is that despite all the current tensions, the export controls, everything, China is positioned to be the ultimate winner when it comes to the application of AI.
So it's a question of who can scale it best.
Exactly. It forces you to ask if short-term policy support at home outweighs the long-term structural advantages a rival might have in scaling an application.
And hanging over this entire volatile picture for every sector is the constant threat of tariffs. Trade policy changes that make any kind of long-term planning feel impossible.
The tariff threat is a ghost at the feast. We saw a commentary from policy advisors, I think it was Hassett, saying that if the Supreme Court rules against the former president on tariffs,
He'll just find another way.
He'll just use other tariff authorities to get to the same place.
Let's pause on that. For our audience, what does other tariff authorities actually mean? What are we talking about here?
We're talking about leveraging emergency powers. It suggests using statutes like the International Emergency Economic Powers Act or certain national security clauses.
Things that give the executive branch huge discretion.
Massive discretion to impose tariffs without needing the usual congressional approval. The point is, the political commitment to that protectionist stance remains, absolute, regardless of judicial rulings.
And if you're a professional trader trying to build a quantitative model, this has to be paralyzing.
It is. According to Bob Pisani's Trader Talk segment, that's precisely the result. This constant volatility around tariffs is making it incredibly difficult to figure out where the S&P 500 should even trade.
The fundamental math just doesn't work.
It's constantly being scrambled. It's less about spreadsheets now and more about reading the geopolitical tea leaves.
So, after all of that, this dizzying mix of bond interventions, rare earth politics, sector chaos, tariff threats, What are the market veterans telling people to do? What's the wisdom here?
Well, we got some much-needed sobriety from the big commentators. Jim Cramer, for one, he said the January rally just felt emotional.
Not based on fundamentals.
Not at all. He was cautioning investors to really focus on stock market rotation.
So rotation out of what and into what?
Specifically, he suggested shifting money out of last year's huge winners, the high flyers. He named Apple and Nvidia,
Okay.
and moving that capital into more overlooked stocks, things with more fundamental value. He also gave some really tactical advice on the geopolitics.
Which was?
Avoid trading on the immediate Venezuela headlines. His argument was that the situation is just too reactive, too chaotic for a retail investor to time correctly.
To stay away from the noise.
Basically, yeah. And that fits with the broader advice we saw, which was investors are just better off avoiding market timing altogether.
The old maxims don't apply.
Right. Trying to, sell in May. It doesn't work when a policy decision on Tuesday can rewrite all the rules. The focus has to be on the long game.
And just for context, when they talk about a severe downturn, what's the actual definition they're using?
The consensus line for traders is a 20% drop in stocks from a recent peak. That's the threshold. Once you cross that, you're officially in a bear market.
20%. Got it. Okay, before we wrap, there was one last piece of data on inflation that I found fascinating. Came from a really unexpected place.
Oh, this was a startling one. It was from market researcher Jim Bianco.
Right?
He gave this incredibly vivid comparison. He warned that Publicious's used car prices are currently rising faster than Bitcoin.
Faster than Bitcoin.
Faster than Bitcoin. And it's such a critical reminder for everyone that the inflation that really hits your wallet isn't just some abstract number. It's happening in these huge, tangible, everyday assets in ways that the, high-frequency trading chatter often misses.
That really does sum it all up. The theme of early 2026 is this lightning-fast feedback loop between a big policy announcement like the bond purchase or the Greenland Gambit and an immediate real-world market reaction.
The market isn't waiting for the analysts anymore. It's reacting in real time to political intent. And I think the defining challenge for any investor right now is connecting that abstract world of geopolitics to the very real, very physical scarcity of materials.
Right.
So given that the lack of AI memory is causing these unprecedented surges in price, and at the same time the U.S. is focusing so much political capital on Greenland's rare earths, you have to ask a question.
What's the question?
How quickly will the race for AI components and for the raw materials you need to make them, how quickly will that race fundamentally reshape global trade policies over, say, the next 12 months? It raises this really important question about whether the supply chain itself is about to become the primary driver of geopolitical conflict.